The United States government just called an emergency meeting on critical minerals. They scheduled it for Wednesday, a few days after silver suffered a 41% crash, the worst in 46 years. Now ask yourself something. Why would the most powerful government on earth fly in international delegations to talk about minerals the same week those minerals got destroyed? What do they know that you do not? And here's the part that really got to me. While you were watching silver collapse from $121 to $72 while your screen was red, while every headline screamed that precious metals were finished, someone on the other side of the world was buying that exact same silver at a 29% premium. They were not panic selling. They were paying more. They were doing it calmly, deliberately, while the Western market was in complete freefall. By the end of this video, you're going to see a timeline that will change how you understand this entire crash. You're going to find out exactly who was buying while everyone else was running for the exits. And you're going to see three things that the mainstream financial media has completely ignored. Things that tell a very different story from what you have been hearing. Welcome to The Hidden Economy. This channel breaks down the financial moves happening behind the curtain. Subscribe, because what we are about to cover is not on CNBC or Bloomberg. If you find value in this, hit the like button. Now, let us get into it. Because this story is far bigger than a crash, I need to set the stage quickly. What happened before the crash matters. But I'm going to keep this tight because I know you are here for the real story. China is securing actual atoms, actual metal, actual physical supply, while the West trades paper promises for those same resources. And now it appears the United States is finally waking up to this reality this Wednesday. Are we seeing the beginning of a resource war, or am I reading too much into this? Here's the timeline one more time. And I want you to feel each entry, not just read it, feel it. Late January, silver 121, gold 5,595. All-time highs, euphoria everywhere. Friday, January 30th, silver crashes 37%, gold drops 9%, panic weekend. CME raises margins. The hammer drops. Forced liquidation begins across every major exchange. Monday, February 3rd, silver hits 72, total destruction 41% gone. SQV, silver limit down across every contract. 5 funds suspended, 16 traders banned. And Shanghai still paying a 29% premium. Tuesday and Wednesday, something shifts. Silver recovers to 85. Gold climbs back above 4,800. Buyers return, the floor holds. Wednesday, February 4th, the United States hosts an emergency critical minerals meeting. Same window, JpMorgan moves gold desk to Singapore. Look at that timeline. Look at every single entry. And you tell me that is a coincidence, because I have stared at it for hours, and I cannot make it feel random no matter how hard I try. Now, before I tell you what I think this all means, let me bring in a perspective that adds a critical layer to everything we have discussed. Ray Dalio, one of the most successful and respected investors alive, the founder of the largest hedge fund in the world. Dalio recently said, "Something needs to prick the bubble to cause a market crash." And at first you might think the silver crash is that prick. But then Dalio said something that stopped me cold. He said, historically, what ended overvalued markets was something that led to sustained outflows of cash. Rate hikes, quantitative tightening, month after month of cash being pulled out of the system. That is what kills bull markets. Not one event, not one crash, a sustained mechanism that drains liquidity. And right now, rates are still more likely to go down than up. Even with wars coming in, the Fed is still on track to end quantitative tightening. The market is adjusting for a slightly less dovish Fed. But Dalio's exact words were the pricking we need to trigger a crash is still not here. Think about what that means. Imagine you're driving at 100 miles an hour. Someone taps the brake, you slow to 95. That is what the wash appointment was, a tap on the brake. Silver reacted like the car flew off a cliff. That massive gap between the size of the trigger and the size of the reaction tells you everything you need to know. It was not the foundations that cracked. It was the speculators, the leverage, the froth, the weak hands. They got destroyed violently. But the road itself, the fundamental case for precious metals, did not change. Not even a little. Remember the 1970s? This is the parallel that everyone needs to understand right now. Gold surged from $40 to $200. Everyone was euphoric. You could not go to a dinner party without someone talking about gold. Then it crashed 50%. Headlines wrote obituaries for the bull market. Analysts went on television and said it was over, done, finished. Regular investors who had put their savings into gold panicked and sold at the bottom. They took the loss, they moved on, they forgot about gold. And then gold went to $800. $800. From $200 to $800. The people who sold during the shakeout missed a 400% move. One of the single greatest wealth creation events in modern financial history. The crash did not end the bull market. It ended the tourists, the speculators, the weak hands, the The structural trend continued without them. The people who understood why gold was going up in the first place, the ones who were not just chasing momentum, they held and they were rewarded beyond what anyone thought was possible. Now look at silver. It went from 30 to 121, crashed 41% to 72, and now it is sitting at 85. Gold went from 5,095 to 4,400. Now it is above 4,800. Both metals bounced. Both found a floor. That is not what dying assets do. Let me be very specific about why the recovery matters. Silver bounced from 72 to 85. That is 18% from the lows. In 2 days, gold bounced from 4,400 back above 4,800. Think about what that tells you. When a bubble truly pops, when something is genuinely going to zero, you do not get an 18% bounce with conviction. You get a small bounce and then a slow grinding bleed downward for months or years. The dot-com stocks did not bounce 18% after the crash and hold. They bled for 2 years. Silver bounced and it held. Gold bounced and it held. Real buyers were waiting at those lows. They looked at the supply deficit. They looked at 680 million ounces of annual industrial demand and they said, this is too cheap. We are buying. That is not hope. That is a signal. Now let me explain why the recovery happened. Because it was not random and it was not a dead cat bounce. There is a reason silver found a floor at 72 and not at 50 or 40 or 0. Solar manufacturers cannot stop buying silver. It is not optional. Without silver paste, the production line goes dark, and silver paste is only 3 to 5% of a solar panel's total cost. Even if silver hit $150, the impact on the final product is negligible. But without silver, no panel, no product, no revenue, that demand is inelastic. It does not care about margin calls or algorithms or panic selling. It buys silver because the alternative is shutting down the factory. And it is not just solar. Companies are reportedly locking up physical supply through direct deals with mines, bypassing exchanges entirely. When corporations start going directly to the source instead of buying on the open market, they are telling you something about supply that no futures chart can capture. They are telling you they do not trust the exchange to deliver. That is why the floor held. That is where the $72 buyers came from. Now, I always give you the full picture because you deserve both sides, and this is important. There are real risks. This was a speculative mania. Prices went too far too fast. A correction was inevitable and in many ways healthy. Marko Kolanovic, who was JPMorgan's chief strategist, has warned silver could fall to $50 as the froth unwinds. That is a real scenario. A stronger dollar could keep pressuring metals for weeks or months. If global growth slows, industrial demand softens. These are legitimate risks. Anyone telling you silver only goes up from here is either lying or selling something. This is not financial advice. Do your own research. Talk to a professional. Never put in more than you can afford to lose. And here is what I'm watching this week. And this is what you should be watching too. On Wednesday, if that minerals meeting produces any language about government stockpiling, if they announce any new bilateral supply agreements, if there is any mention of silver specifically as a strategic resource, that changes the entire calculus. Because government buying is not speculative demand. It does not panic sell on a Friday. It accumulates over years. Watch for the official statement after the meeting. Watch for any executive orders in the days following, and watch the Shanghai premium. If it stays above 20% even as Western prices recover, that tells you the physical market is sending a message that the paper market has not received yet. I will be covering all of it on this channel. Now, before I give you my personal take on all of this, I want you to sit with 4 questions, because I have been trying to answer them from the bearish side for days, and I cannot do it. If this was just a bubble popping, why is Shanghai still paying 29% more for physical silver? If demand collapsed, why did China suspend funds to prevent excessive buying, not excessive selling? If silver does not matter, why did the biggest bank in America move its precious metals desk to Asia? And if none of this is important, why is the United States government hosting an emergency critical minerals meeting this Wednesday? Nobody in the mainstream has answered a single one of them. So let me try. Here's my personal take, not as a financial advisor because I am not one, but as someone who has been staring at these charts, reading these filings, and losing sleep over this data for days. I think we just witnessed something historic. And I do not mean the crash. Crashes happen. They are painful, but they are normal. What is not normal is what this crash revealed underneath. I think Friday, January 30th was the day the paper silver market and the physical silver market officially divorced. They used to be married. They used to move in the same direction, roughly at the same speed, with small differences here and there. That marriage is over. What we saw this week is 2 completely separate markets pretending to be one. The Western paper market, driven by leverage and algorithms and margin calls, crashed 41%. The physical market, the actual metal that factories need and governments are stockpiling, barely flinched. Shanghai kept paying over $100 while New York was selling at 72. That is not a normal divergence. That is a separation. and I do not think they are coming back together anytime soon. And here is what really bothers me on a personal level. Wealth does not disappear in a crash. It does not evaporate. It transfers. It moves from one set of hands to another, from people who react to headlines to people who read data, from people who panic at red screens to people who have spent months preparing for exactly this moment. Rewind to Friday morning. Your screen is red. Every number is negative. Your gut is screaming sell everything. And at that exact moment, someone in Shanghai was paying $11 for the same silver you were about to dump at 78. They looked at a 41% crash and said, I will take it. At a premium that was not a retail investor, that was sovereign money, strategic money, the kind of money that thinks in decades, not days. That is a wealth transfer. And it happens every single time. Every crash, every panic. That is why I make these videos, not to tell you what to buy or sell. I genuinely do not care about that. I make these videos because I believe the biggest disadvantage regular investors have is not money does not access. It is context. The ability to zoom out when everything is screaming at you to zoom in, the Shanghai premium, the SHFE floor price, the jpmorgan relocation, the government meeting. None of that was on your screen on Friday, but all of it matters more than the red candle that was. So when people ask me, is silver dead? I think they are asking the wrong question. The right question is, which silver? The paper silver that trades on your app, maybe that market is broken. They just proved it. But the physical silver that China is hoarding, that JP Morgan moved to be closer to, that governments are holding emergency meetings about, that solar panels and missiles and semiconductors physically cannot exist without, that silver has never been more alive, and the fact that those two silvers now have completely different prices is the single most important development in commodities in my lifetime. That is my honest take. I could be completely wrong. But I have looked at the data from every angle I know how to, and I keep arriving at the same conclusion. That is the answer to the question I asked at the very beginning. Who was buying at 72 while everyone else was panicking? Now you know, and now you know why the crash was real. The pain was real. But 1,874% of premium growth over 12 months tells you which direction this story is heading. And what happens in that meeting room in Washington on Wednesday might just determine how fast we get there. Drop your take in the comments. Is this the end of silver or the setup for something much bigger? I read every comment, and the sharpest analysis on this channel comes from you. If this connected dots you had not seen before, send it to one person who needs to see this. And if you are not subscribed, fix that. This is the hidden economy. I will see you in the next